From PSG Asset Management side, there's a lot happening in the market at the moment, and we thought just to forward you a quick short email just to tell you what we're currently doing in our portfolios. And maybe just with that one, the two fund managers I've got today is Justin Flew and Lal Sankar. You know them quite well. Justin, since the mid of June, a lot of actually happened in the market. If you can maybe just give us a brief feedback in terms of what you've done in the portfolio and what most of the fund managers have actually done in their portfolios.
Sure. Morning, guys. Hope some of you have been able to take some leave and catch a bit of a break halfway through the year. Yeah, so it's been quite an interesting couple of months, actually, start to the year. And I think it's been a nice opportunity just to quickly share with you how we are kind of navigating this and how we're processing it. So, the volatility has become quite apparent. And I think, the way we're framing it is very much 2 time horizons. And it's very important to acknowledge both of them. And then to have an investment strategy that prioritizes one over the other. So in the near term, it's quite clear to us, and I think it has been for a while. It's something we've been talking about for certainly the last couple of years, as we expected inflation to ramp up, and then that probably overshot on the upside. There's going to be a normalization process, and I think we're starting to, we're in the middle of that at the moment. So we would expect inflation to slow. Particularly US financial conditions are tightening. We would actually expect a US recession as a reasonably high probability event, but we do think it would be mild. I don't think it would be as extreme. I think there's a lot of market participants potentially fighting the last war in terms of the last few recessions, which have been very severe. And that doesn't necessarily have to be the case. And I think we all know the challenges in Europe and China. I think for us, what's much more interesting and what's much more important, and perhaps easier to predict because it has a much more solid underpin, are some of the longer term themes. So you would have heard us speak for a while now about the underinvestments in key parts of the economy. That's really led to the challenges that we're facing now in terms of shortages, and we think that's not going to go away. That's probably going to lead to pent up investment demand. You've got US households, US banks, US corporates, all in pretty good financial shape. Inflation will probably be more persistent. We'd expect it to come down. And then finally, we're living in a very different geopolitical world, and where it's much more dispersed. I think there's different centers of power and a lot more conflict. Might not be hot conflict like we're seeing in Ukraine at the moment, but there's probably going to be a lot more geopolitical conflict and volatility. So that's kind of hasn't changed really. That's been the situation for the last 6 months. We do think there's an opportunity now with current prices and volatility to really be prioritizing that blue bucket, and particularly in the funds that we're responsible for with mandates with longer term time horizons. So our equity funds, our balanced funds, our flexible funds. Now we're really focusing on that right hand side. And I think there's some fantastic opportunities. So I'm just going to share a very quick snapshot. Use the balanced fund as a quick case study. I think what you'll find is we incrementally adding to equities. So equity markets generally have been very weak. This environment is reasonably good for us. So our equity picks have had a pretty good year so far. I think we're well ahead of the market. And a lot of that is because there's this very strong normalization and a recovery in areas that have just been left for dead for the last decade. So I think that's something that will continue, and there's good opportunities in our funds on the equity side. Some of them have been volatile more recently because of demand fears, and we'd be looking to take advantage of that. So what you can see here is probably a tick up in some of the more growth assets. We've been adding to foreign property, foreign equities, and adding incrementally to SA equities as well. And then, I'll leave Lal to talk about bonds, but I think suffice to say from the balance funds perspective, we really liking these bond deals at the moment, and we certainly taking advantage of them, and we remain very cautious on credit. So, we're not taking risk in all areas. There's some parts of the market we're quite risk averse. We've been quite deliberate about how we use our risk budgets. Lal, over to you.
Thanks, Justin, and thanks, Charles. And Thank you to you guys for listening. Hopefully this does help sort of contextualize what has been a really tough fixed income market. So I think, if you're looking at the market year to date, it's actually in our minds the first real test that the fixed income market has had. So for years, you've had decent returns from nominal bonds, credit, inflation-linked bonds has also come to the fore, and cash has been good. And if you add this to what we think has been quite divergent performance in the market over the last 2 years, depending on whether you use duration or you focused on credit-heavy allocations, you had a very different outcome. I think a lot of clients are also asking us, how do we get to a decent income return for the rest of the year? So I think, if you look at the beginning of the year, it's understandable why there was broadly a consensus call that, it was the right thing to have in the funds having nominal bond durations. Most of our peers, and I think the market would have been sort of quite heavy in nominal bonds and duration. And I think that has been the key point that it has caused a lot of pain. And I think, as you would know, the bond curves globally has sold off. So I think what you don't have this year is the offsetting factors that you might have had in previous years from credit or from cash markets that would be able to offset this. And inflation-linked bonds also wasn't, able to sort of provide a buffer against what has been a terrible market for nominal bonds. So a tough year. The pressure points have been typically there. And for funds that use property or equities, I think, the similar result we've seen across both, which has made it a bit difficult. So we're seeing a lot of questions come through in terms of what clients can expect from the fixed income space. And I do believe this is the first test for a very wide category where, lots of guys do different things to try and produce the income result. And I think it's going to be telling in the years ahead. So I think just a broader high level on what we're doing in our buy list. I think, we started the year having a view that we think, has become the consensus view that inflation was going to be higher. We, in our buy list, you guys will know it's quite central to our approach that we strike a conservative inflation expectation, and we ratcheted our inflation expectations higher. Looking at the longer term theses that Justin outlined, we think, the shorter term funds, while some of the positions we would have held in the beginning were quite attractive, we think there was quite a bit of volatility ahead. So part of looking at a high inflation number, we looked at what the market is offering on a fixed rate basis, and we think NCD started to become attractive. Everybody will know that the market priced at certain points in this year for almost 3.5% in interest rate hikes. And so that gave us an opportunity to buy an asset class we really like. Lots of stability in yield, high liquidity, and ability to give these back to the banks when we had the opportunity. And these were giving us real yields in areas like credit where we weren't seeing that. So a very good opportunity added back to the portfolios. And then we used the chance to upweight inflation in bonds. And I think this is an area where if you have a bit of willingness to execute in size, we've been able to do quite well for the fund. So specifically, I'll touch on a brief example, being the shortest inflation-linked bond, almost 1.5 years in term. Both our income funds have about 20 to 30% exposure there, just given what we expect to see this year in terms of inflation pressures. What we haven't seen yet, in terms of the offshore pressures, it might be a much higher inflation path than the market's thinking. So we've got quite a bit of exposure there, low duration, but a lot of protection for the funds. And then what we've done in the beginning of the year for the lower risk mandates, being the income funds and the stable fund, is downweight some of the the conviction on the longer end towards the middle of the curve, which means we've got a bit more of a robust exposure, less potential volatility. So the result from our buy list is obviously more inflation protection, a little bit more stability in yield, and I think through the funds, which I'll talk about next, we were both then positioned in a way where we could achieve a decent result this year without taking on too much risk. So I'll touch on the diversified income fund. I think this is the category that has struggled quite a bit. So the range of returns, I think to June, we've seen some funds have a 6-month drawdown. Some funds, particularly the credit-heavy funds, have done well. So as I mentioned, duration struggled this year. But what we did is we brought these changes through to the portfolio. And in addition, we sort of moved from a let's call it a topish duration of about 2.8 early this year to about 2.3. We got an opportunity to do that, during March. We also cut the equities in the portfolio just as a broader acknowledgement that there's a wider range of outcomes, and particularly some ideas that done really well, as Justin pointed out, and these funds don't have to be exposed there. We also reduced preference shares that did quite well last year, and so if you look at the tables in front of you, we would have had let's call it a bit of a lower exposure to growth assets alongside a lower duration, but then within that duration it was quite robustly composed or constructed to ensure we still get good income returns. So a bit of lower risk into the end of the first quarter, and then as you can see, we kept quite a stable allocation to offshore cash, which is sometimes helped during this year. Sometimes the correlations have broken down, but through the cycle, we think it will give a more robust outcome. So through the funds, I think it's obviously been a tough period. And the acknowledgement is that fixed income markets, typically where we've been, has been attractive, but there's smart ways to get through to a decent income result for clients in the year ahead. So at a high level, I think I'll just touch briefly on where we are allocating capital. So as I mentioned, curves have sold off. NCDs now, the 5-year NCD, we could buy it at 9.7%. So I think if you look at the next 5 years, the odds are you'll earn a decent, good real return there. And the market's still looking for 2% more in interest rate hikes, which we don't think is likely before the end of December. We quite like to, this middle area of the nominal bond curve. You're now getting the 10-year bond at 11.4%. Historically, if you were to buy in at those levels, you've only made more than 15% annualized return in the next 12 months. So very good starting point, and we'd be adding capital, off the back of having some risk capacity. And then inflation-linked bonds, we think is a gem that typically we don't see guys use it in size in the space, but we are using it in our portfolio. So we still like duration. We're quite cautious around credit. Lots of auctions have come through, and we see a lot of demand at even tighter spreads. We would caution that these notes are still expensive in our minds, and then a lot of structuring has gone on around these credit notes, which we think present potentially more risk than the market's paying attention to. So we are quite cautious there. So using very little of our credit risk budget, using a lot more duration, but with a lot more capacity still available if the market gets cheaper. So I'll summarize it. We think inflation is probably going to be higher than 6 this year. Cash levels, I think if you did around 5.5% in a money market fund, you'd be okay. So we think a good outcome, for income funds is around 7 to 8 and potentially a little bit higher. We do think the market has some pent-up capacity to give some returns back, after a very, very abrupt performance period, in the second quarter. So we think we're encouraging clients not to jump off and to sort of look through this period, and we're quite well positioned. So I'll leave it at that. Thank you very much, and I hope this does help give you guys some context for the fixed income space.
Thank you, Justin. Thank you, Lyle, and especially Fundhouse for the opportunity to forward you this short video clip. If you guys do have any additional questions, please just pop me an email. Thanks a lot.